Well, good morning to you all. Tony Virtue speaking, Virtue and Partners, with our regular monthly update as we come to the end of the financial year. I think the main things we're looking at the moment really are the repercussions of the budget from a few weeks ago. Let me just recap on some of the key points with this. We're going to move from a capital gains system where 50% of the gain was tax-free, and the other 50% taxed at the marginal rate of tax. They now want to move from 1 July 2027 to a system whereby there'll be an indexation. What does that mean from a practical point of view? It will mean that whether investments are of an aggressive nature or of a defensive nature, they will get the same capital gains tax allowance. So from a behavioural economics point of view, I'd imagine people will be far more defensive in their investments. It begs the question, what are we doing investing in global shares from Australia, where we're expecting very substantial capital growth and hence a capital gains tax that will be added onto the marginal rate of tax for somebody, maybe taking them up into a higher threshold there. Now, the probability of this is that people will sit on their hands for quite some time, wait and see how this plays out. We're seeing that in the property sector. You can read for yourself, but auction rates at below 40% here in Sydney. Treasury is saying, well, rents would only go up $2 a week and property prices would only go down 2% more than they may have done otherwise. As Sir Humphrey would say, I think that's pretty optimistic. In the event that we really undershoot, in the event that we have 6 months of really negative performance, I think they'll have to unscramble this egg pretty quickly. They have put in a couple of adjustments already insofar as allowing small business to have a higher threshold for valuing and capital gains tax on their business. Yesterday, for instance, they excluded for future property purchases no debt within or no mortgages within self-managed super funds. So, you know, these are very, very big changes, and now, of course, the real question is, well, how does that impact on economic behaviour? It'd be hard to think that people will just do the same and just pay a bit more tax. I think the most probable sort of aspects of this is that there'll be a period where if people don't need to do something, they won't do something there. So let's just leave that there at the moment, and we'll park that, and I guess that's going to be a major talking point going forward. I would say that as it stands, every asset in Australia will need to be revalued, both listed, which is fairly straightforward, but unlisted at the 30th of June 2027. So that's going to be a big job there. Every property in Australia, that's rented out, but all of your unlisted assets, your company assets or whatever, will all have to be valued. So at the very least, there's an awful lot of red tape just to change a system where the actual tax take will be very, very marginal. And in fact, it could actually go down depending on indexation, depending on consumer behaviour there. Moving to globally, well, the big story was SpaceX listing. This is the biggest IPO in history, in quotes, and Elon now is a trillionaire. The share price went up substantially, dropped off a bit, and I think you'll see there'll be a little bit of moving around there. It's actually only 4% of the company that's being listed, and there are escrow conditions on a lot of the shareholders, so there'll be a limit to how much this moves around. I've indicated in my notes how we can invest in that. Some of you are in PE1 at the moment, Pengana, private equity. 14% of that actually is in SpaceX at pre-IPO there. We have another one coming through, which will be Anthropic and OpenAI. I think they'll just wait and see how markets settle at the moment, but that's expected in the next couple of weeks. And again, there is a Pengana AI fund, artificial intelligence, which is one of the ways of getting into that. If you look at the graphs, it just shows that these companies, take SpaceX at the moment, which is coming at number 5 in the world, that is bigger than the entire Australian stock market, to put this in context. So, you know, when we're looking at investing, you've got to really say at the moment the likely growth is coming from overseas, and Australia very much more of an income play. That means we're going to have to review a lot of asset allocation as we get through this year, as we really take stock on what does this mean and what is the after-tax position for clients. I would say that superannuation, particularly for those of you over the age of 40, looks more and more attractive, notwithstanding the issues on direct residential purchases. For investments in as an example, in global equities, the capital gains tax on that remains at 10% rather than your marginal rate of tax in the accumulation phase. Those of you who reach 60 and have a decent balance, you have a lot of optionality with this. So to some extent, those already with assets are okay, and there'll be a real move towards generating more consistent and higher income streams. Those are the next generation coming up. That's going to be a lot harder, and we are really scratching our heads here as to how best to serve you in that area. In aggregate, the global markets have been quite strong. If anything, there's concerns about some of those private credit funds and just the quality of their lending, and particularly to software companies, and if there's going to be an issue there. So in aggregate, I think it's a time to be careful. We're certainly keeping larger cash balances. We're certainly not in a mood to take unrewarded risk, and I believe that it really is the mood of the community. Property, I just touched on what happened globally when other countries tried to do this, and what actually ended up happening was that you'd have corporations that would come in and build a 200-unit block. Rather than then selling that to individual investors, they would keep the entire block for themselves and go to a buy-to-rent model there. And that's become increasingly common, certainly in Germany, you see in my notes, in the US, in the UK. What actually happened was that rents actually went up substantially, and there was quite a lot of niggle between this as to tenants versus owners and what local government did there. So expect there to be more corporate buy-to-rent come into the market there. Finally, as I mentioned, we're coming towards end of the financial year. I put the usual notes there. Try and maximise the super where you're able to, do your prepayments, etc. Those of you who've got shares in your own name will be in touch about a bit of what we call bread and buttering, just selling some down and with some of the losses to offset against some of the gains that you can carry forward there. It has been very busy here, as you'd expect. Thanks for your support. We're working all the hours we can to meet the needs, to cut back the red tape, to be as relevant as possible. Yes, we'll use AI behind the scenes to be smarter in our efficiency, our note-taking, but we are utterly committed to those personal relationships, that individual client service. We want to meet you out there on the streets and know us, know that we care about your circumstances. We understand the cost of living pressures that Australia is under, and we're working with you carefully there to ensure you have enough money to live the lives that you deserve to live at this time. That's enough for today. Let's get the year end behind and I'll talk further. Tony Virtue, when experience pays.